Okay, so in this video, I'm going to attempt to give you a quick breakdown on how to read an income statement. The reason why you would want to know this is if you're investing in a company, this kind of tells you how efficient that company is at generating income. So let's start with the top line. This is the total revenue, which is also referred to as the top line. Let's say this business made $10,000. So we want to see what it cost them to generate that $10,000. That's under your cost of goods sold. That includes your materials that it took, the things that you had to buy to make the product that you're making, and the labor costs, how much you had to pay people to make that thing for you. That's often referred to as COGS, cost of goods sold. Let's say that cost you $6,000. You subtract that from your $10,000. Now we arrive at our gross profit. So we have $4,000 as gross profit, but we're not done yet. We need to figure out what our operating cost was. This is often referred to as EBITDA, or earnings before interest, taxes, depreciation, and amortization. So these are things like research and development, administration, so you have to pay people to run your website or to do your accounting for you, and ads, like on Google or YouTube, you're running ads online. This is all, let's say that all costs you $500 to do. Then we have to look at depreciation and amortization. So depreciation is how much value your equipment loses over time, or whatever you're depreciating. And then amortization could be your patents or your software. How much does that cost you every year? So let's say your equipment depreciates at $150 a year and your patent or whatever costs you $50 a year. So that's $200. So then you subtract that from your gross profit to get your EBIT, which is earnings before interest and taxes, which is $3,300. That will be then we'll look at your interest expenses. So if you had to pull out a loan to make all this money because you didn't have your own money, then that interest that you're paying on that loan is $1,000. Let's say you have really bad credit. This was, they borrowed money. They really took a shot here. They were hoping to make a lot more than that. So then we have our earnings before taxes, or EBIT. We subtract this to get that, which is $2,300. So our earnings before interest and taxes minus our interest expenses. So now we have our EBIT, our earnings before taxes, and we subtract our income tax. So if you have a C Corp, that's usually a flat rate of 21% federal tax, and then the state could range at various percentages. Let's just say it was 4%. So this would be 25% out of that. You subtract that, and that gives you your actual net income. So this is how much money you actually took home if you were the business owner of this company. Out of every $10,000 you make, you only get to take home $1,725. Anyways, this is a quick breakdown. Like, subscribe, hit the bell for more videos. Life could be easier. Have a wonderful day.